Welcome. Today, we're going to dive deep into the strategic evolution of Trident Limited, covering the period from 2021 all the way to 2026. Now, based on the source material we've analyzed, we're going to lay out the full picture for you, both the bull case for its growth and, of course, the bear case that highlights the risks. So, let's get right into it. Here's a quick look at our roadmap for today. We'll kick things off at the core thesis. Then we'll explore the key pillars of Trident's transformation. After that, we'll weigh the headwinds and threats. From there, we'll analyze its balance sheet, review its performance over the last 5 years, and finally, we'll land on the analyst's verdict. All right, first things first, let's get to the heart of the matter, the core thesis. This is all about understanding the major strategic pivot Trident has been making. So what's the big story here? Well, the fundamental narrative is this shift from being a traditional asset-heavy textile manufacturer to becoming a much more diversified, brand-led powerhouse. A big part of this is Trident capitalizing on that China Plus One sentiment, while at the same time pivoting towards higher margin sales right here in the domestic market. And the numbers for Q3 FY26 really back this up. We're seeing a resilient 14% EBITDA margin, a very strong debt-to-equity ratio of just 0.3x, and an impressive 30% year-over-year growth on its retail platform. Okay, now let's unpack the bull case. This argument is really built on several key strategic moves that the company itself calls its pillars of transformation. The first pillar, and you could argue it's their greatest strength, is what we call a defensive moat. And that moat is its vertical integration. This slide shows it perfectly, the entire flow from farm to fashion. By controlling the whole value chain, from raw materials like cotton and wheat straw, all the way through spinning and weaving to the final textiles and paper, well, that allows Trident to shield its margins from the wild swings of global commodity prices. This creates the stability they need to really fund our big brand expansion. So how are they moving beyond just being a factory? Well, management has a roadmap they call Strategy 2.0, and it really rests on 3 core pillars. First, building up brand equity with a really aggressive push into the consumer space, or B2C. Second is diversification, using the synergies between their different businesses. And third is digitalization, which is all about professionalizing the core business to make it more efficient. And you can see they're serious about this by bringing in top executives from the FMCG world. Now, this focus on brand equity, it's a huge strategic shift. Historically, Trident relied heavily on those big box retailers in the US, but now they're focused on capturing the much higher margin spending from consumers here at home. That 30% year-over-year growth you see on their MyTrident platform, that's the proof in the pudding. And it's all supported by innovative new products, like premium yarns made from bamboo and hemp, which gives them more pricing power. Let's move to that second pillar, because this is where it gets really interesting, the diversification hedge. This diagram shows a really powerful internal engine. You've got the high-margin paper and chemicals businesses acting as a cash cow, just generating steady cash flow. That cash is then used to pay down debt and fund the big capital projects needed for growth in the more cyclical textile division. It's a brilliant symbiotic relationship that really smooths out the bumps in the road. And it's not just what Trident is doing internally. The broader macro landscape is giving them some significant tailwinds. On the policy front, you've got government programs like the Production-Linked Incentive, or PLI scheme, for textiles. On the demand side, a recovery in U.S. housing starts is a direct boost for home textiles. And of course, geopolitically, that global China Plus One sourcing shift continues to be a major benefit for Indian manufacturers like Trident. But, of course, no analysis is complete without looking at the other side of the coin. So now we need to pivot and talk about the headwinds and the key risks that really form the bear case against the company. And that same macro landscape that provides tailwinds also creates some serious friction. Global logistics, for instance, are still a huge challenge. Those volatile shipping costs can really eat into export margins. On the home front, Trident is dealing with a tightening labor market in Punjab. And internationally, let's not forget, the competition from established textile hubs in places like Vietnam and Bangladesh is absolutely fierce. If we dig a little deeper, we can really group these risks into 3 main buckets. First, you have input risks. The company is still very sensitive to cotton prices, and a bad crop could lead to a margin squeeze just like we saw in the 2022 crisis. Second, market risks. This includes intense competition from unorganized players in the domestic market and the long-term threat of digitization to the paper industry. And finally, you have execution risks. And this is a big one. That exciting brand-led growth has to be balanced against the very heavy capital spending required to expand capacity. Okay, so with the bull and bear cases laid out, let's analyze the financial foundation. This is what really underpins the company's ability to navigate all these challenges. We're talking about its balance sheet. And this chart, it just visualizes a massive success story in deleveraging. The debt-to-equity ratio was brought down from 1.2x back in 2023 to a much more comfortable 0.3x by 2026. This kind of financial discipline is a key reason for the company's resilience. You can see it in their Q3 FY26 performance, where they held on to a 14% EBITDA margin despite all the external pressures. That really turned market sentiment bullish. Now, to put all of this into context, it really helps to look back. So let's trace Trident's journey over the past 5 years and look at this timeline of its resilience. This timeline tells such a compelling story. Back in FY 21-22, we saw the surge. Post-pandemic demand drove record revenues. But that was followed in FY 22-23 by the perfect storm, a nasty combination of high cotton prices and cooling U.S. demand. FY 23-24 marked the recovery as inventories were cleared out and new capacity came online. Then we had the diversification phase in FY 24-25, where the paper segment hit peak margins. And all of that brings us to the current state in January 2026, which is defined by strong performance both at home and in exports. So after looking at the strategy, the risks, the financials, and the history, we finally arrived at our last section, the analyst's verdict, straight from the source report. According to the source material, the investment verdict is accumulate. Now, for context, the stock is noted as trading at a price-to-earnings ratio of 28x, which is seen as reasonably priced when you look at its 5-year growth path. The final takeaways are pretty clear. Trident is leveraging that China plus one trend effectively, its downside risk is cushioned by that vertical integration and the paper hedge, and the real upside potential is driven by that MyTrident B2C expansion. It's important to note the report's analysis does not give any specific price targets in rupees. And really, it all comes down to this one phrase, which I think perfectly encapsulates the core thesis. The analysis doesn't see Trident as just a simple manufacturer, but as a cyclical play with compounder aspirations. This acknowledges the ups and downs of its industry, but it also highlights the strategic moves it's making to build a long-term compounding growth story. So the key question for investors really is how well Trident can balance these two identities as it moves forward.